Okay, I want to welcome everybody to the 2024 Digital Assets Update. This is the second in the Southeastern Alternative Funds Association Market Insights webinars. Today is May 8, 2024. This webinar is being recorded, so if you're not able to attend live or you have to drop off early, we will make this content available on the website, theseafa.com. That's TheSeafa.com. So I'm really excited as the president of SEAFA to have three terrific speakers joining us on the digital assets update today. You're going to hear from them for the majority of the next hour. But before we do that and we get to introductions, what I'd like to do is take a minute and give some important updates about SEAFA. So if APG could advance the slides, please. So SEAFA's mission, I want to reiterate, why we exist. SEAFA's mission is to provide effective forums for the education, interaction, and advancement of both its members and the Southeastern alternative investment community. So this market insights content, really does fulfill multiple pillars of our mission, which is to provide education and an opportunity to advance the conversation, in this case, around digital assets, crypto, and Web3. So I'm excited about what we're doing here today. Next slide, please. We couldn't make this content and this organization possible without the support of a number of corporate members. And so I want to take a minute here to leave this slide up so that you can see the wide variety of organizations across the country, with a number of them headquartered here in Atlanta, where SEAFA is headquartered, but also throughout the Southeast, that are instrumental in supporting our organization. They generously sponsor on an annual basis, and in some cases are sustaining sponsors. The sustaining sponsors of SEAFA are the longest standing professional service firms in the Southeastern marketplace, and that would be Trident Trust, Elliott Davis, Merrick's Prime Services, Warren Averett, and Ackerman. But I also want to recognize a number of other silver bronze sponsors who you can see here on the page. And so some of the folks attending may work at these organizations or may work with them from the standpoint of fund accounting, administration, legal, banking, and a number of other areas. So thank you to our corporate members, and we'll get to how you can get involved with SEAFA here later in the presentation. Next slide, please. I want to recognize the SEAFA Board of Directors. So these are individuals who work full-time in our industry and generously donate their time, talent, and support to help our organization. We are a volunteer board. We are supported by the folks at APG, and I just want to make sure that I take a minute to thank each of them for the support they've provided to SEAFA over the years and on an ongoing basis. Next slide. And then I want to provide a few updates that are important for those folks that have a real vested interest in our marketplace and alternative investments in the Southeast. So number one is events. We are working behind the scenes with our board, with our sponsors, and with APG to put on a number of in-person events for 2024. We also are going to be hosting an increasing number of virtual events because we have a lot of folks that are not able to get out of the office, either due to travel schedules, work commitments, busy tax season, etc. So we do a number of virtual events that we can record and make available later. These Market Insights webinars is a new format. Those are held every week at 11 a.m. Eastern Time. This is the second one that we're doing this week. That content is recorded. We do prefer to work with folks that are active in the Southeastern market, but it's not a requirement. So we're very busy putting together those webinars, and that calendar is filling up through the spring and summer. So that's something that is exciting and new. We also have a new podcast called SEAFA Spotlight, which is available on major podcast platforms. And that features one-on-one interviews with industry executives, both from asset owners, LPs, but also GPs and fund managers, as well as professional service firms. The point of the podcast is to provide a more in-depth conversation, typically on a one-on-one basis, with folks that are, making things happen in our industry. And so if you're interested in being a guest on the podcast, we can work around your schedule, record that. It is a video podcast format, but also available through audio, and be happy to have you on. The SEAFA Spotlight is also available on the website, theseafa.com. Another exciting new initiative that we are launching is what we're calling the Next Gen SEAFA Board. So we are looking for executives that have some industry experience, but are also, I would say, earlier to mid-career. And these are folks that are going to be the next generation of leaders in our marketplace and in the alternative investment space here in the Southeast. We currently have 2 individuals, one from Byte Investments and another one from Cott Law Group, who have committed to serving on this inaugural SEAFA Next Gen board. We're looking for 3 additional individuals, so we would have 5 total. We would like to introduce that board at the summer barbecue, which is going to be held in July. So if you're interested, or you have an employee or a colleague who you think is very committed and dedicated to their career in the Southeast and in alternative investments, whether they work at an investment firm, a professional service firm, or an investor, have them reach out, and we would love to get them involved. And then lastly, and this is one of the most exciting initiatives, coming soon is a program called SEAFA Advance. And it's a version of an accelerator for those of you that are familiar with the startup community and the concept of an accelerator, which is really to provide resources for founders of early stage companies. SEAFA is launching its version of an accelerator. It's going to be called SEAFA Advance, and it's for aspiring alts fund managers. And it's going to be a program where aspiring fund managers who are thinking about launching a fund or some type of investment platform in alternatives over the next 2 years would have an opportunity to be a part of a cohort. And that cohort would get access to startup and fund launch resources, subject matter experts, marketing tools, access to LPs, in terms of feedback, and an opportunity to present in front of a large audience at an annual conference that we're working on for 2025. So if you're interested in that, and if you're thinking about setting up a fund or an investment platform over the next 2 years, or you're early on in your fund journey as a GP and would like to get access to best practices and other important resources from fund launch, decisions, technology, vendors, banking, custody, but also the marketing, fundraising, and important capital formation process, please do reach out. Next slide. And then lastly, and most importantly, let's get to the content. In the next 45 minutes, what I'd like to do is have the folks that are here on the panel and been patiently waiting talk about digital assets and crypto. It's clearly a space that's growing. A lot more investors, both retail and increasingly institutional investors, are trying to get up to speed and get educated on what's happening in crypto, in digital assets, and Web3. So we have 3 terrific panelists joining us today: Robert Swarthout, founder, CEO, and PM of Teton Crypto Capital; Jed Breed, founder and general partner of Breed VC; and Phillip Moran, who's the CEO and co-founder of Digital Opportunities Group. And then I'm your host, Andres. I'm the SEAFA president and also run a couple of businesses, one, Endurance Strategies, which does a lot of work in alternatives. So with no further ado, what I'd love to do is go to our quick just agenda for today. We're going to do a 45-minute discussion after intros, and then we're going to conclude with Q&A. So with that, I'd love to get started. If we could just bring the panelists up, and then we'll go ahead and jump in. So what I'd like to do is for each of the 3 fund managers here today, I'd love for you to just give a brief introduction, and I'll start with you, Robert.
Well, thank you for having me. So I am a software developer turned fund manager. I had started and sold a few software businesses and decided I want to do something new. And my interest in crypto personally turned into what became the thesis for Teton Crypto Capital. It's a long-only fund that focuses on digital assets that solve commercial problems or seek to solve commercial problems.
And where are you based, Robert?
I'm based here in Atlanta.
Great. Okay, next, let's go to Phillip Moran with DigOpp.
Sure. So my background, I was previously an allocator. I managed over a little over 3 billion, allocating mostly to like quantitative trading strategies and systematic macro, equity market neutral, um, these sort of strategies. Did that for several years and was head portfolio manager of that book before co-founding Digital Opportunities Group, or DigOpp, as we like to go by. You know, we got to have that fun two-syllable name. A little over 2 years ago, and we are a hedge fund ourselves. Our mandate is to deliver a pure alpha style return stream focused on capturing inefficiencies across crypto, across digital assets. And so to do that, we run a multi-portfolio manager style model, or the pod shop model, you might hear it called, where we are looking for trading teams and portfolio managers who themselves have unique trading strategies focused on digital assets, and we plug them into our centralized risk infrastructure where we're monitoring that risk in real time. And I could, at some point, we'll dive more into like exactly what we mean by risk. Yeah.
That's great. Thank you. And then let's go to you, Jed.
Hey everybody, my name is Jed Breed. I'm the GP and founder of Breed VC. I'm based right outside of Miami in Coral Gables. My background is an operator. I've founded companies, I've sold companies, I've had built teams. On the crypto side, I've been in it for 11 years now. I started in 2013 as a miner, mining Bitcoin, Dogecoin actually. I was an early Ethereum participant. 2018, I joined Circle. I was the head of digital assets at Circle, which is one of the largest companies in crypto. I was responsible for launching USDC there. After Circle, I joined Accomplice, which is a large VC doing DeFi strategies. And then I started Breed VC about 2 years ago. We are a venture company focused on private investments, and we do early stage, founder focused, thesis driven companies.
Great. Well, one of the things about our panel today is that we have three very distinctive, let's call it investment styles, investment strategies represented. Robert, you run a long only kind of fundamental bottoms up process of looking for commercial utility in alternative tokens. Phillip, you are running effectively what we call in the industry a pod model, and looking, for the best places, for value and managing risk across, it sounds like multi-strategy. And then Jed, you are looking at early stage founder led thesis, kind of models, and bring, experience not only as an operator, as a founder, having built teams, but also looking for, probably pretty early stage crypto Web3 related projects. So we have three very distinctive styles. And what I'd love to start with, and I'm going to go to you, Phillip, first, is market insights. That's the theme of these webinars. So when you think markets and providing sort of perspective and insights with respect to digital assets, a lot has changed over even just the last 6 to 12 months. Characterize the market in terms of what you look at on a daily basis.
Yeah. So for us, we are looking to capture alpha. We're looking to capture returns kind of like regardless of the direction of the market. So whether things are going up or they're going down, we work to be agnostic to the regime, right? But digital assets generally, if we just kind of like look at, where things are now and, what the market dynamics have been like, digital assets generally have had very strong momentum, just generally, like as a risk factor, let's say. So if we think about momentum in equity markets or commodity, like whatever, it's a pretty powerful effect in digital assets. And so it's not hard to imagine why that's the case. There's kind of like a lot of retail participation, depending on what token you're looking at, there can be sort of a lack of liquidity, and that can sort of, drive these momentum effects. So when we look at Q4 of last year and even the first quarter of this year, the trend effectively, I mean, the momentum was just very powerful. It's very, kind of like a one-way market. Recently, the momentum it's been a little like choppier, frankly. I hate to use kind of some of this like market technician verbiage, but at the end of the day, like momentum is pretty powerful in these markets, and you've just kind of seen that trend is kind of it's become more of like a choppy market, and that's important from the perspective of strategies that rely on momentum, either to the upside or the downside. So that's just from a price perspective. Now, if we look at let's say like retail participation, or even just like levered trader participation, let's say there was you can like measure that participation through what's called the funding rates in the markets. And so these funding rates are effectively interest rates that traders have to pay to trade derivatives in crypto. These are called perpetual swaps. Perpetual swaps are by far the most liquid instrument in crypto. It's not spot markets, it's perpetual swaps, just by far. And so in order to trade those, you have to pay a funding rate. If there's more demand to go long those perpetual swaps, this blows out that funding rate and makes it really expensive from a funding perspective to participate via those instruments. So in Q1 and even Q4, those funding rates, it got wild, right? It got crazy in terms of like where those funding rates blew out to. And there's actually strategies out there that effectively just look to capture that funding rate in a risk neutral way. Just it's a carry trade. Now, what we've seen recently is that funding rate has just screamed back in very recently. It's, we went from, even approaching like triple digit annualized yields. I mean, like no joke. And then recently that's come way down, way down to where we're kind of floating around, like high single digit to kind of like low teens-ish kind of annualized yield, depending on what asset you're looking at. And so that's a big marker for participation via derivatives. And so that kind of speaks to some cooling off in terms of like market participants, like on the long side in particular. There's a few more things I could say, but I'll pause there to give everybody.
No, that's a good setup. I mean, look, I'm listening to you, and I think one thing that immediately comes out, in just some summarizing thoughts is, I think the perception that crypto and digital assets and Web3 is kind of child's play, if you will, and it's not really serious money, it's not institutional. That's just not the case, right? Like all three of you are running institutional strategies with institutional approaches, and we're going to dig into that. But one thing I think that the unfortunate part of the asset class is that, tends to be that the media focuses on the hype and what's going wrong and all the problems that the space has had and attracted some bad actors, which is good. It's cleaned up. But I think if you look back to the history of any asset class over the last 200 years, like there's always been challenges to get to where we are going to be in, 3, 5, 10 years, depending on your crystal ball. So with that said, Jed, I want to come to you next. You're looking at builders, operators, people building things on the very early edge of this market in Web3. So when you think about insights into the market that you can share, what have you seen over the last 6, 12, months and even currently that gets you excited in terms of your mandate?
Yeah, so crypto it's an interesting market that operates in cycles. So each cycle, typically there's some sort of innovation that causes the entire market to explode with interest, market cap, new projects. And then since it's such a nascent market, people lose interest, something breaks, and then it goes down. But when it comes back down, it's still bigger than it was before the last cycle. So we had a cycle in 13. That's probably there was a small cycle in 11, but 13 was like the initial like Bitcoin, Ethereum, Dogecoin cycle. 17, we have the ICO boom, which was a way to do capital formation for companies, and there were a lot of nefarious companies that came out of that like the regulatory kind of clamped down on. And then 21, we obviously saw the DeFi boom. decentralized finance, and then NFT boom. So those are two big innovations. And now this cycle, like the cycle is weird. So 23, late 23 and 24, the huge catalyst was the Bitcoin ETF, spot ETF. So that is something that the industry's been trying to get through for about 10 years. And so it was finally approved. And once we saw that, we saw quite an institutional blessing of the industry. We see inflows of 12 billion, I think now $13 billion. BlackRock obviously has the largest ETF. So we're now seeing regulatory clarity. And I think that's like one of the biggest kind of handicaps to our entire industry, especially in the US. There's a lot of regulatory arbitrage with companies kind of moving out of the US and starting. And so we're starting to get some clarity around stablecoins, around obviously the Bitcoin ETF. So that's like kind of where we are right now, and why Bitcoin in the general market has increased so much. As Phillip was saying, we're kind of in a choppy side for the last month or so, kind of in a choppy place where we're not really sure where things are going to go up or down. And then in the future, like what catalysts kind of are coming, and that's like a longer discussion that we could have. So on the venture side, it's like with these cycles, it's kind of like a double-edged sword. So you have companies. So during the down market, like for example, we're a vintage 2023 fund. And so it was right after FTX, valuations are low. It's really hard to raise money, and it's a great market for VCs as a buyer's market. Now the market is hot again. We're seeing a lot more founders come in, which is good. We're seeing a lot like more interesting projects, but the valuations have increased significantly. So I think as a venture investor, the key is being super disciplined on not just jumping out and trying to back, everything that's like hot right now. And so there's different narratives that come and go, and I think that it's key just to really go to first principles, be really founder focused, and not just jump at the hypes, as we saw with the 21 cycle, where many VCs kind of got burned by allocating at the top of the market.
Yeah, terrific. Robert, I want to give you an opportunity. You run a fundamental, token strategy looking for commercial utility. How do you characterize the market today? And how have you characterized? I thought Jed did a great job of kind of giving us a sort of a short history of different cycles. So I'd love to hear, from your perspective about, the market and how you're viewing it today.
Yeah, generally, I just view the market as a lot of assets that are not priced correctly. At the end of the day, it's meme coins seem to be the only thing that the market cares about. So it's like all over the place. But when you start looking at assets that do commercial utility, many people aren't recognizing what I believe is the long-term value in the mispricing that is happening there. Obviously, it's a much longer-term bet when I look at things than I think, even on the VC side. I think some of these bets I'm looking at are even longer-term than VCs. I might look at an investment, but it's generally a new market that is trying to find its footing and try to attract people into the space. So
yeah, and I think you mentioned this, Jed. Like we have seen with the Bitcoin ETFs getting approved. There's close to a dozen of them or so, and Fidelity and BlackRock and Bitwise and several others, kind of leading the pack in terms of inflows. This discussion is not about Bitcoin and the ETFs, but it is about sort of insights into the market. And I think anybody that's watched the space over the last several years knows that ETF approvals was a big talking point, and has brought a lot of capital, particularly retail capital, into those vehicles. What I wanted to do is maybe ask the next question I want to ask is around when people think about investment strategy and sort of how they go about building an investment strategy. I think with a nascent asset class here, a lot of really interesting points were raised, and I could go to all three of you, but I want to start maybe with you, Robert, this time, and then we'll go to Jed and then finish with Phillip. When you thought about building your investment strategy in this nascent asset class, in your case came out of founding and building two software businesses, How did that background inform what you elected to ultimately create and build with Teton?
That's a great question. For me, it really came from my love of what I found is the blockchain technology. I mean, like, it's revolutionary. People talk about it all the time, but I don't even think that we've fully figured out what it's going to be used for in all the use cases. Much like the internet was in the early days, you have a lot of exploration that's happening. So it just evolved. I think that in some sense I have an advantage because I look at it with a technologist eye, the investment versus maybe a true investor. But there's other things that obviously that I'm probably missing along the way that I get to learn. It's a lot of reading. And it's a lot of trying to figure out if these teams are real, if they're telling the truth. A lot of smoke is blown in this space, and trying to figure out, what I call is proof of human. Are there really people behind these projects? Not just a LinkedIn profile and some stuff. Love to see YouTube videos that kind of start to prove out that these teams are actually executing and connecting and doing all the things you need to see to just run a basic startup, this even outside of blockchain. So.
Yeah, I think you raised an important distinction between crypto, Web3, digital assets, and let's just compare it to other, even alternative asset classes, private equity, private credit, real estate, where there are more, I would call it, frameworks and more structures, regulation, institutionalization, right? Best practices, indices. I mean, we could go on and on. And without all that, it ends up kind of migrating, candidly, to social media and to relationships and to, networks, which I want to dovetail back into you, Jed, because we all know in VC, networks, relationships, access to founders, access to the builders at the right stage and time is critical in VC. So your background with Circle, one of the biggest, market participants in this space, and obviously a big player in stablecoins. Then from there, add another crypto-focused VC. I would clearly, think that informed a lot of how you thought about building your platform. But I don't want to be presumptuous. So could you talk about that background and what led you to ultimately forming Breed VC, and what did you see out there that was a gap or where there was a need?
Yeah. So I started angel investing in 2016 and built out a really strong portfolio over the years, and that kind of led into, with those results, kind of led into and I've had lots of people ask like, hey, I want you to allocate my money based on your access. I think the biggest edge that it's important in VC and our edge here is access. So like I'm a crypto native. My team is a crypto native. We're on chain every day. We're doing DeFi. We're providing liquidity and Curve. We're restaking all these kind of various primitives that we use on a day-to-day basis. So that like really helps us kind of get in, like, we're in different Telegram groups and Discord groups, and so that really helps us get onto the ground floor as people are building companies. Before it's just an idea, before they even start around. So just talking to them and getting connected. And then, so it's like, we kind of live and breathe in it every day. And the second part is I've been being in it for 11 years now. And like part of my like superpower is building networks, connecting with people, building communities. And so, the BD side is for deal flow is really important. So we're pretty much connected with every crypto VC, and as well as a lot of different builders and founders, and that's kind of where the best deal flow comes. In terms of like informing the strategy, crypto is a super nascent space. So I think what's interesting is we're seeing some VCs that start funds that are focused on one very specific category within crypto, and that could be Web3 gaming or Web3 or NFTs or just DeFi or crypto AI or consumer. So I think that's kind of like a delicate balance that you need to play as a VC, because if you focus just on one corner of the industry, you're going to miss out on a lot because it moves fast. There's new things are being built every day, every month, there's new narratives. And so I think what's really key, what's really informed our strategies, obviously, like we've operated various principles, but we've lived in founders' shoes. And so we really go after quality top founders that are building quality projects that we think are going to be around for long haul. So it gives us some flexibility in terms of our focus categories as well. So I think that's like a big kind of question in VC. Like, do you just focus on one corner of crypto, or do you kind of go more holistic across the space?
Yeah, fantastic. Interesting. Phillip, when I think about what you characterized, and feel free to get technical, feel free to, to articulate, to the extent you can and will share. You came from having been an institutional allocator. I'm dying to ask you, are they doing anything in crypto or digital assets? But it probably isn't fair since you're not there. But I would love to hear, the skill sets, the discipline, the things that you're trying to bring to DigOpp in terms of this pod shop model. I think people that understand the hedge fund industry understand the pod shop model. There's some well-known ones out there, Citadel, Millennium, just to name a couple. They're looking for edge and talent, and they can give you the capital. And it does feel like that multi-manager pod model, has really attracted, from a hedge fund assets perspective, like a lot of attention. With that said, in your background, like what were you trying to create with DigOpp, and why did you set up this particular model? And how have you found this model to be beneficial given the nascent, very early innings sort of asset class that is digital assets?
Yeah, so well, one, from a skill set perspective, the skill set of being an allocator, evaluating trading strategies, are they uncorrelated to risks that you care about? Are they, orthogonal, as we call it? Are they, do you expect them to deliver a, positive expected return, right? Because just because they're uncorrelated doesn't mean necessarily that they'll make money for you, right? Like that sort of skill set transfers over into crypto, quite readily, right? But when we look at this asset class, it's just far more inefficient than traditional assets. Effectively, every traditional asset class: equities, rates, commodities, FX. And it's also newer, right? So in equity markets, you might have these really well-defined risk factors like value, momentum, quality, low volatility, right? And then you sort of have these other sort of risk factors in other asset classes. In crypto, we don't even have a well-defined, S&P 500 equivalent. Right. There's like a few groups that are out there kind of vying to create that index, whether that's like Bitwise or CoinDesk or, some of these groups. So even just from the perspective of like, what the heck is my market risk factor, and how am I going to evaluate my, orthogonality, my uncorrelation or my correlation to that thing, right? So there's sort of like all these really interesting, open questions, and that's where we step in. That's where we have that edge, is on that risk management side. Like, what are the risks that we care about? There's the market risk, there's the strategy style risk, right? How do we model these things? How do we think about how we want to expose ourselves to each of these things? How do we think about tail events, right? Another challenge that you get in digital assets is that you really have a pretty short series of data available, right? So when you're building these portfolios in traditional assets, you might be able to find a trading team who has, whatever, a decade of track record, for whatever it might be. You don't have that in crypto. So you're kind of operating on a shorter time frame, and you have to like kind of be creative as to how you perform that evaluation. But to answer your question about the pod model, why we believe that is so effective in crypto is, well, as we said, this asset class is nascent, and it's volatile. Things are changing all the time. right? And so from the position that we sit in, where we have sit here as this sort of platform developer, the platform manager, we're fairly agnostic as to where those sources of return come from, right? All that we need is that we can have effectively control over that risk, right? And we can model that risk. So we can step in as risk manager when required. And that pod model is just, it's very flexible, and it's very effective for, where we are at in sort of like the state of this asset class. Also, to be frank, there's a lot of quality trading talent in this ecosystem, but there's not a lot of people out there who I think have both the expertise to underwrite those strategies, as well as sort of the crypto specific expertise, the crypto specific knowledge as to, like, the counterparties, the venues, the trading products, and and all this sort of stuff. And we see how, crazy that got in periods like FTX blow up in November of what was that, 22, right? Or even the USDC depeg, right, in March of last year, right? So there's these kind of idiosyncratic crypto specific risks, and you just have to be, prepared, to manage through those things.
Yeah, it sounds like you need to find folks who, in your case, need to have that crypto native knowledge that Jed alluded to, but also they need to have sort of like finance, underwriting, portfolio construction, portfolio risk, like they need to understand like asset management, asset ownership, and like building a platform as a person deploying capital on behalf of LPs. Finding those two together, sounds like it's more of that. That's where sort of that intersection is. Jed, I want to ask you, as you, having a venture firm now that it's a couple years old, we saw a lot of venture come into this space. You alluded to it, prior to FTX, and using that one just as a marker in our industry. Prior to even the ETFs being approved, you saw a lot of venture, and I don't want to call them generalists because that's maybe not fair. They probably did have quite a bit of expertise, but we did see a lot of capital flood into this space. And it's not the only space that venture came into, and it happens in our industry, right? When there's opportunity, capital will go pursue it. And we saw that with hedge funds going into venture, right? And making, doing those late rounds in 2021, 22. Would love to ask you, when you saw that happening, whether you were in venture, but now, like, has there been a shakeout? Because I think one of the criticisms of venture is that they would find a project, back a team, and then their exit was when, the tokens were listed. And they would, I don't want to say dump the token, right? But flood the market with a ton of liquidity. How is venture, and maybe it's just Breed, like, how do you think about, building behind these founders, 10-12 year time frame for most venture funds, and also like potential liquidity? How do you sort of underwrite that?
Yeah, so the last cycle, 2021 cycle, we saw a ton of larger, more generalist VCs come into crypto. This time, not so much. It's mostly crypto native funds that have allocated to the space for years, are still doing it. Like I'm just starting to see some larger tier one non-crypto funds lead kind of later stage, bigger deals, but nothing like 21. Yeah, and in terms of your question on like liquidity and risk and like how do you manage tokens? So like crypto venture is a really unique beast compared to traditional venture, because we have the token model, right? So you fund a company, and the liquidity, typically in traditional venture, there's two liquidity events, and that's either an acquisition or IPO, and those take 5, 8, 10 or longer years. With crypto investments, we typically can see a liquidity event with a token generation event in 2 years, 3 years. Obviously there's locks, investing, and all that kind of stuff. And so, you know, when you create a fund, the fund life is really kind of what dictates your strategy on tokens. So like we're a 10-year fund, which is, you know, traditional length of a VC fund. So we actually do we do token deals and we do just equity deals as well. So ultimately to get DPI back to our LPs, I think that's where they really find a lot of interest, because these things can do really well. Like we backed a company called Athena recently, that did a token launch, and it's already trading at a $15 billion FDV, or fully diluted valuation. So like these are the kind of, you know, and I'm not gonna say what the valuation was on the lower rounds, but like these are kind of returns that can be returned back to your that you can see pretty quickly. And then, I mean, obviously, like there's lockups and stuff, and we'll ultimately see what the price is when VCs can exit. Now, the thing with VCs also, it's like a delicate dance you want to do with selling your position versus supporting the team and the founder. So you don't. So there are some VCs out there who kind of have a reputation for like the moment that it unlocks, they just dump on retail, which is everything's on chain, so everybody can see it. So I think the longer term VCs that maybe have a conversation with their founders can strategically exit the position over a longer time period, I think are ultimately going to win. Because once you kind of get the reputation, you kind of get blacklisted from getting into oversubscribed deals. So that's kind of our take on it as these things go liquid quicker. Not being a long-term focused with the founder, helping them build. Again, we're a 10-year fund. We see 3-year funds out there. We see 5-year funds out there. So that's really kind of the idea that we have with this different asset class with tokens.
Yeah, makes sense. I want to maybe have a conversation around portfolio construction, idea generation, the research process. Robert, you've said a couple of times in your comments the concept of commercial utility. Can you explain what that means to folks? And the second part of that is, you know, after explaining what is commercial utility, like how do you underwrite it?
Yeah, so commercial utility in the sense of Teton is focused on 4 different markets: cross-border payments, trade finance, supply chain management, and tokenization more generally. Basically 4 incredibly unsexy topics, but they're largely measured in trillions depending on how you look at them. You know, if you use trade finance as an example, the vast majority of that process is still done on paper when you look at it from beginning to end. It's hard for the smaller exporter to get financing or importer. There's just so much opportunity to make a gigantic technology leap in that market, to largely skip the last 20 years of the internet and jump into a digital age where they can get instant funding on chain and get paid much sooner as an exporter. The research process is nothing like what I understand traditional research is. It starts on Twitter and it goes down rabbit holes. Whether it's Telegram groups, Discord groups, or other, just private groups in general. And it's a ton of, breadcrumbs and trying to figure out is there links between them? Is there not? You start building a thesis around teams. If I'm watch a YouTube video, for instance, I love to see these teams on panels at, say, a conference with, if it's, cross-border payments, I love to see them on with a central banker or something that's outside of crypto. It starts adding a little validity potentially to what they are trying to solve. When it comes to tokenization, that one is accelerating really quickly. I thought this bull market cycle, there might be one of the themes that we would see outside of the Bitcoin ETFs, and it looks like it might be shaping up that way. Admittedly quicker than I thought. When the Bitcoin ETFs launched, then Larry Fink was on CNBC that day talking about it, and he said the next thing that's going to happen is tokenization, and now you see them doing it so quickly. I would have put my bet at over a year before you saw something, not 3 months. It's pretty cool to kind of see them, how fast they're moving. But there's a long ways to go.
So just as a follow-up, and then I want to ask Philip kind of a related question next. So when you talk about commercial utility, it's solving a real world problem. You mentioned four, like, but then it goes to a process, if that's what you call it, of underwriting, which starts in, you know, social media, but then goes down to these rabbit holes, right?
Right.
But it dovetails a little bit with what Jed said, which is, you know, really being able to plug into who are these participants, you know, and I see some commonality. My question for you is, how, as a person that came from outside the industry, right? You haven't characterized yourself as a crypto native like Jed did, but you had an early start in the space, and you clearly have a technology background and have built 2 successful software companies. How are you closing that gap in terms of access, knowledge, you know, to identify those markers and or red flags where it's like, interesting problem they're solving, but not the right team, or don't have the right experience or the right traction?
Yeah, it's a great question. So, you know, part of it goes to what is the makeup of the team? Do they come from the industry that they're trying to solve the problem in, or are they a bunch of blockchain guys trying to find they got a hammer and looking for some nails? When I first see that, when it's a hammer looking for nails, it's almost a turnoff. It's like, fine, I can spend my time researching elsewhere. You know, when they come from the industry, they obviously know the problem that they're solving, or think that they know the problem they're solving, and they have the connections. They, you know, and it may be back with regulators. You see that with a token called Quant. They are based in the UK, and the amount of inroads that they've made within the regulatory bodies that make up the UK and some part of Europe is second to none in many facets. So at the end of the day, it's just, you know, it's a educated guess about where it's going. But at the same time, you know, when I see a project that feels like they are spending more money on marketing than they are product development, no thanks. Like those are more looking to do like a token dump, in my opinion. So
yeah, okay. Philip, I want to ask you, with the model and the way that you characterize trading, juxtaposing traditional asset classes, rates, currencies, you know, with this nascent asset class. I've heard these 2 gentlemen, Jed and Robert, talk about, you know, the people side of the business, talk about the projects. I hear you talking about and using, you know, let's call it quantitative, risk, technical, and you know, knowing and acknowledging that these are nascent markets. When you're looking to underwrite and manage risk, how do you share with us what that process looks like, and how does that interaction go with this talent if they don't have a long track record? Like, they have a 1 to 2 year track record, 3-year track record.
Yeah, that's a good way to think about it. Like a 3-year track record is going to be very rare in this asset. I mean, it exists, it's there, but it's very rare. Yeah. So for us, we have a pretty defined pipe as to how we handle this problem. You know, it's pretty straightforward. You know, first, this is going to flow through into, you know, evaluating these strategies relative to the risk factors that we care about. So this is like, are they uncorrelated to the market? What happens during, you know, stressed periods? That's actually, like, we place a lot of emphasis on what happens during stress periods, because this is, you know, this classic issue. It's, you know, like Nassim Taleb will talk about this kind of stuff, where it's like, you know, your correlation matrix is, you know, garbage. It's like, all that matters is what happens during, you know, the black swan or whatever. So, you know, we don't quite take it to like that extreme, but we do pay a lot of attention to the stressed periods in these markets. You know, like, what happens to those strategies all of a sudden, you know, are the correlations across our strategies going to 1, you know, because then, okay, you know, we think we've built this nicely diversified book, but it turns out that, oh, you know what, crypto just, you know, kind of is all the same risk factor. And then you're kind of, you know, up a river without a paddle, you know, when things get tough, you know, or something like this, right? So we, you know, perform that quantitative analysis. And then we're going to look at these, you know, potential alphas against what we're already exposed to. So against our current book. And eventually, as this flows through, and we dig deeper into the underlying strategy, we collect very, very granular data across all, because it's at the end of the day, we are holding all these assets, we're custodying all these exposures, right? And so it's like, at any given point, if we want to, we can, slap a big red button and just turn everything off and, wind down a portfolio, do whatever we want to do. And so, we're paying a lot of attention as to like what these exposures are. Are we seeing, let's call it like clustering from a position level across these mandates? And sometimes, we'll kind of like, just based on like a market regime, we might say, okay, we're seeing something a little fishy. Let's go ahead, scale down risk, let's scale up risk. So we can make those those fine-tuned, adjustments.
Yeah.
Yes. And then doing that risk managing over top in terms of, like monitoring drawdowns, this sort of thing, are funding rates blowing out? Does that make it attractive for, a given, subset of strategies? Should we scale those up? Like these sort of things. I can certainly go deeper into how we think about market specific risks. I don't want to make the audience fall asleep, but I do think that there's a lot of really interesting opportunities available in this asset class because of the lack of well-defined risk factors to get creative as to how you define those things and how you dig into the data to just, so like, I guess to give you an example, it's like once you define your market risk, which as I said earlier, that's not even like a defined thing in this asset class. Like people will say like they might just use Bitcoin as their index, and that's probably not a good idea, but it might get the job done, But then it's like once you go beyond your market risk, now there could be, let's call them like thematic risks in the market, right? So like a recent thematic risk through Q1 and kind of into Q4 could have been like the alternative layer one theme. It's sort of, you had this rip in Solana, you had this rip in whatever these other like Aptos and whatever it might be, these like faster layer ones, right? Like these things can kind of all of a sudden become a risk factor, right? So is your P&L now all of a sudden across your book being driven by this market specific risk factor, right? Because it's great to make money on the upside of that thing, but then what if you're exposed to that on the downside? How do you how do you think about your timing risk of these factors? So that's, there could be, like the meme coins came up earlier, right? It's like, are you, because the stability of a lot of these assets, and what I mean by stability is like, how do they interact between one another? That's very important for us because we can have, long short strategies that we're running where we're trying to capture the spread between two tokens, right? The same way you would do in an equity market neutral strategy, trading Apple versus Microsoft or whatever. It's the same kind of deal here. But that relationship as to how these tokens operate together is not necessarily stable. And there can be some real wackiness that happens all of a sudden, right? And you thought that you were safe, but it turns out that you were actually exposed to, one of these wacky risk factors. So there's I'll stop there, but, there's a lot of really interesting stuff in the world of risk factors, risk management in this asset class.
I mean, clearly, I think we've driven home the point through this panel discussion, and this is why the SEAFA Spotlight exists, candidly, for each of you as an invitation to dive deeper, because I think each strategy, as I'm listening, and I hope our viewers and SEAFA members would agree, each of these strategies and approaches to this market, I think you could easily spend additional time on. But I want to wrap up, and I want to give Jed you the opportunity to start with this last question before we go to some sort of final remarks. You did a really great job at the very beginning of the webinar talking about this is a market that moves in cycles, and you went through from 2011 all the way to here recently with 24. We'll call it the Bitcoin ETF approval cycle. As you look ahead, and that's one of the challenges, but also why people entrust capital to VCs is they want to make investment decisions in venture around what's going to happen. right? What this venture team, is able to spot those really market changing, power law sort of dynamics. Like they give you the capital to go sort of find that. When you think about the history of crypto, Web3, digital assets over the last, call it, 7, 8 cycles, and then looking ahead, you talked about how you build relationships, you're on chain every day. Where do you see the most exciting and most interesting opportunities? And what do you think are some of the next cycles to play out?
Yeah. So part of what we're really focusing on, so what we constantly have seen is infrastructure is consistently getting funded and doing well. New L1s, we mentioned Solana, Aptos, Say, etc. Faster transactions per second. Ethereum's scaling solution is utilizing layer 2s, so layer on top of Ethereum that settles down to Ethereum, and so those can have higher transaction throughput. We're seeing some things about with DA layers and all kinds of various infrastructure bets. Now, I think we've seen enough infrastructure. The reason why it keeps getting funded is because it does incredibly well. Retail will typically gets excited about these opportunities, and venture needs to go where ultimately they think that will do well. And historically, they call it the L1 trade has done very well. So the next kind of thing that really matters is actually people utilizing this infrastructure beyond speculation. And so like what use cases can come out of that. And so we're seeing some interesting things on the consumer side. We have like decentralized social networks, something called Farcaster, which is doing quite well. And we're keeping an eye on, because we all want people to use this stuff. We all, instead of just keep building. And so we're really focused on consumer, and kind of the goal with consumer is, so if you use crypto, it's still kind of difficult, high barrier to entry, using a wallet, transacting on chain. And so we're now starting to see applications being built where the user doesn't even know they're using blockchain in the background. And so that, I think we're starting, like there's a lot of different technologies. One is called Intense, another is called chain abstraction. I can get into like the details, but basically everything, you can do everything cross chain, doesn't matter which asset you're using, you can buy whatever asset you want. And I think that's the ultimate goal, is like just a Web2 experience using a decentralized blockchain network. So that's interesting that we're focusing on. It might sound trite to say, but we are pretty excited about decentralized AI. So AI is like, I think, one of the most important technologies in our generation. And it's kind of crazy that these large organizations are having these private models and not exposing the weights, or and basically slapping a proprietary lens on top of AI. So crypto is basically designed for an open source type of environment. And so we're seeing a lot of interesting technologies about foundational models being trained through a network of decentralized nodes. We're seeing verification. Like a really good, interesting use case would be like, let's say you're asking ChatGPT or whatever a medical question about a surgery, right? Like when you type that in, like how do you know like what the inference is actually saying? Like where did the data come from? What models actually being used? And so we're seeing solutions where it's provable that which model you actually wanted to use answered the question specifically for those like high use cases. So decentralized AI is like another thing we focus on. And then picks and shovels. So again, we're a long-term fund, 10-year fund. We like businesses that have true business models, revenue generating models that's repeatable and increases. So like for example, like we did a company called Spearbit. which is smart contract auditing. So smart contracts are what basically you use to build different decentralized applications. And once you launch a smart contract live, it's kind of set. It's hard to change. So there's a huge demand for auditors to check the code to make sure there's no bugs. And so that's like an example of like a really strong business model where there's a huge supply and demand imbalance. And so so picks and shovels is another focus area of ours.
That's great. No, you gave us a number of really interesting themes. So Robert, I'm going to give you a chance to make a final comment. You know, you spoke earlier about commercial utility. Maybe the market hasn't quite recognized utility, and in your case, maybe not even pricing in some of the opportunities that you see. When you look ahead, one thing we haven't spent a lot of time on is regulation and the lack of clarity around regulation. You know, we did get the BTC ETFs approved. We have started to hear whispers, and more than whispers, maybe around stablecoin legislation. I don't want to force your hand and say, is legislation like the big unlock? But maybe you could mention legislation and regulatory clarity. And, you know, when you look ahead and you see opportunities to find utility and underwrite teams, like what gets you excited, you know, for this space in the future?
Yes, regulation's a big piece for me, especially in the markets that I care about. I can see it maybe not being as important in others, but you know, when a crypto company wants to work with some traditional business of some sort, but that business, say, is a bank's not going to touch crypto until there's sort of like clear regulation in place. There's many countries around the world that are getting it right, or at least attempting to. The US has taken the opposite strategy of head in the sand and whack-a-mole. And it's getting exhausting, admittedly. You know, I think, you know, you're right. Stablecoin does come first, potentially this year. I've been wrong about this so many times. I'm not willing to even gamble on when it's going to happen, but I'm ready for it to happen. And I just think that, like, you know, Jed mentioned AI. You know, you're starting to see like potentially some crossover in, say, tokenization and AI. It's really curious to me right now. Some of these, you know, might find models or systems that want to functionally transact with each other. Well, blockchain and crypto is a great use case there, and something that's public and both in, you know, and if that can pull the AI world in more of a open source world, I'm all for it, because what Jed said there was is one of my big worries. It's when people talk about AI, I'm like, I just kind of shake my head. I'm like, this thing can go bad so quickly. So, you know, I just generally, you know, regulation's a big thing. I beat the regulation drum all the time on my podcast, and I just ready for it to not be a topic, and we can kind of move on and kind of see what this technology really can do versus being handcuffed, because it's US is kind of at the control of it right now.
Sure. Well, definitely something that I think all those invested and that want to get invested will be watching over the, you know, the next few years. Phillip, you get the final word before we do our you know, our closing commercial of SEAFA. I want to ask you, you know, you came from the institutional asset owner world where you know, a lot of capital, a lot of human capital, a lot of tech, a lot of people to analyze, you know, these big markets. And now you're building an organization as an entrepreneur and as a co-founder. When you look ahead, and when you, as you alluded in your remarks today, like, there is a lack of liquidity, but there's also a lot of volatility. You have a lot of retail money. You're getting, you know, you're starting to be able to see more trading teams, but they don't have long track records. When I hear you talk, I hear you, there's some good things and some challenges. When you think about this market and building DigOpp out and growing, I'm curious, you know, number one, like what gets you excited in your team as you build the organization? Where do you see more needs? And then also, like, investors, you know, we haven't talked a lot about LPs, but if they're familiar with the pod shop model in the context of these traditional asset classes, have they shown interest in this model with the content in the context of digital assets and crypto?
Yeah, so there were a few questions there, so I might have to ask you for a reminder as I kind of try to tick off each of them here. But yeah, so let's see. I guess if we start with just kind of like the like current challenges and kind of things we see in the market. Yes, as you mentioned, like there's the challenges that you mentioned, relatively short track records across, the pod teams, the trading teams that are out there, relative to traditional finance, that is. The caveat that I would put to that, though, is that in traditional finance, so it's like when I was looking at a quant strategy, a short term, like what I would call like a short term strategy, would be, potentially something that operated, on kind of like a few weeks kind of holding period. Like that to me was like, oh yeah, this is like a pretty quick strategy. Now, a few weeks, that's like long term in the world of crypto trading, right? So it's like the trade horizon is
Compressed.
truncated,
Yeah.
yeah, substantially. And so that actually helps quite a bit from that sort of like track record perspective, right? Because then it's, you get more data points, you get your sample size is larger. So that's helpful. Does that also present challenges in the future? Right? It's like, do those short-term alphas become more competitive, harder to capture? Probably, right? The other challenges that you have across this ecosystem, there still is a lot of fragmentation across, trading venues. That means we have to do a lot of work on our side, to build the pipes to be able to connect in sort of like a unified way across these venues. Like the world of prime brokers in crypto is it's quite different from what prime brokerage looks like in traditional finance, like substantially different, right?
Yeah.
There's there's still not really any sort of like they're starting to pop up, but there's not as much of this sort of like a unified order book, let's call it, that you can hit, right, across all these venues. Which has been around for like a long time in traditional finance, right? So yes, there's all these challenges, but to us that's just like, one person's challenge is another person's opportunity. And so that's, to us kind of a good thing. It's
Yeah.
we don't mind it.
Well, it's going to keep you busy, and
That's
it's going
right.
to keep you.
No,
Yeah.
yeah, for sure. And so and now your other question,
I was just curious,
uh
like what
yeah,
when you talk about investors,
yeah.
how are they coming around to, the crypto trading strategies versus like the hedge fund quant trading strategies?
Yes. Yeah. So as everyone else has mentioned here, both Jed and Robert, the regulatory question is still, something that comes up even with what we're
Mhm.
doing, right? So so there's that. I think that with and if we talk about the world of institutional, investors, that's like a super broad spectrum. This could be everything from, let's call it like ultra high net worth, even high net worth, in sort of like small single family offices, all the way up to pension funds, endowments, sovereign wealth funds, right? And so there's sort of like a vast spectrum there. I think when you talk about the larger institutional allocators that are out there, so the endowments, the university endowments, the pensions, and the sovereign wealths, on that side of the spectrum, those institutions have engaged with like VC and illiquid stuff. We largely have not seen them engage with the liquid universe in crypto. Whether that's maybe there's a little bit of dabbling with some like long only liquid stuff. And there's a couple of uh pension funds out there or foundations that dabbled in some sort of like yield related strategies, and some endowments as well. But largely from the trading, like the pure, like we're talking about trading strategies, right? Like trying to exploit spreads between things, trying to exploit, both the upside and the downside. Um, that uh that is still, we don't see them jumping into there. So it's really
Yeah,
kind of at the other end of the spectrum where we see like the institutions engaging with these style strategies.
that makes sense.
Um,
Yeah.
yeah,
Yeah, that makes sense because a lot of them are driven by actuarial, models, consultants, and other gatekeepers, and and venture is a space that's more established largely in and there's more similarities there. So that makes sense. Well, I
And
don't mean to cut
especially,
you off. Yeah.
oh no, please, please. Yeah, I was
No,
gonna say one more thing, especially after FTX,
right.
that is still kind of like left some overhang. Yeah,
Yeah,
I think it's gotten a
there's
lot better, but
definitely
it's
still
still.
some scars. Yeah, there's still some scars. Well, I thought this was a super helpful, initial conversation around digital assets, and I appreciate Robert Swarthout, you at Teton Crypto Capital, Phillip Moran at Digital Opportunities Group or DigOpp, and Jed Breed from Breed VC. I appreciate each of you taking time away from investing in the portfolio and seeing clients to spend an hour and 15 minutes with us today. If you're interested in this content, I will, invite these gentlemen all to join me on a SEAFA Spotlight where we can go in more depth on their particular strategies, but I'll leave that up to them. And I thank you for joining me today. If you have to drop off, I'll let you do so now. If SEAFA support could bring back up the slides, that would be super helpful. I just want to highlight an upcoming SEAFA event. We are partnering with iConnections. Many of you know iConnections. If you're in the alternative investment industry, they host the Global Alts Conference in Miami every winter. Down in South Florida, they usually get a couple of thousand people. So we're really excited to be partnering with them this year to power the annual SEAFA Summer Barbecue, which is taking place at Piedmont Park on July the 25th. We're looking for our biggest audience ever, which would be over 200 registered. And in participation with iConnections, they're hosting an event the night before at, I believe it's going to be at Bully Boy, which is a local Atlanta venue, and that is going to be open to the industry, and it's going to be a general networking event with a number of other service providers on July the 24th. And then there's going to be some other events, breakfasts and luncheons around those events. And the goal is eventually to turn the entire week into Atlanta Alts Week, where we can have conversations, interactions, networking, and obviously a lot of education for folks in the industry. So look forward to that happening in the years ahead, and you can get more details about the barbecue and other events around the barbecue on our website at theseafa.com. Okay, next slide, please. Lastly, I wanted to, invite you, if you're listening, whether live or to the replay, that SEAFA is moving to a membership model this year. So we're excited about that, but it's going to introduce some changes. Approved investors will continue to have access to SEAFA content and events if they're approved, meaning qualified purchasers, qualified clients, or accredited investors. They will be complimentary members. Fund managers and professional service firms will have a small annual fee. And that is to support all of the content that we are offering and will continue to offer as we scale up. So we think it's a tremendous value. And then we also offer memberships for corporate partners, both at bronze, silver, and gold levels. And if you're interested to see the details and benefits of those various packages and memberships, you can go to our website for more information and to sign up. Next slide, please. And then lastly, I just wanted to, thank you all for joining us. Thank our panelists and the SEAFA support team, and just let you know if you have any questions about SEAFA in terms of how you can get involved, as a member, as a sponsor. If you have event ideas or content you'd like to contribute, please reach out and email me. I'm Andres Sandate, the president of SEAFA, and you can email me at the email address you see here on the screen. Again, look forward to joining you all in July here coming up shortly at our barbecue, and also for some other webinar and live events that we'll be putting on here as the summer gets rolling here shortly. That's all for today. Thank you, Robert Swarthout from Teton Crypto Capital, Phillip Moran from DigOpp, and Jed Breed from Breed VC for joining us. That's it for today. Thanks, everybody. Have a great weekend ahead.
Thank you.
Take care.
Thanks. Bye-bye.